Now that you know the accounting equation, let's go through each of the components of the accounting equation. Remember, the accounting equation says assets equals liabilities plus equity. Now let's take a look at the type of assets that a company can own. Remember, assets are items that a company can own or has control of. The first item that you will typically see in all companies as an asset is cash. Cash includes liquid cash like dollar notes, plus any amount of money that's kept in bank accounts. Anything that is readily convertible to cash is also called cash. The next asset we're going to talk about is called accounts receivable. There's another asset called notes receivable, and I'm going to cover both of them together. Accounts receivable represents amounts that a company is waiting to receive from their customers. Accounts receivable is created when the company sells on credit. In your homework questions, you'll see sentences like ABC company bought $300 of supplies from XYZ company on account. Whenever they say on account, that means you are selling or buying on credit. Typically, accounts receivable is created when there are transactions that occur between two companies, not necessarily with consumers. So let's say company A sells something on account to company B. Well, company A has an amount that they are waiting to receive from company B just because they've sold something on account or on credit. When things are sold on account, it's typically 30 days, 45 days, or sometimes even 15 days credit terms. So the customer will pay within the credit period. There's no interest involved. It's just extending credit as courtesy because it's typically a repeat customer. So accounts receivable represents amounts that a company is waiting to receive from its customers. Notes receivable is very similar. Notes receivable is when a company sells on credit. However, the customer signs an IOU. It's called a note or a loan, and the customer has to pay interest on the balance. For example, let's say that Pepsi sells Dallas Cowboys $5 million worth of Pepsi products, and instead of paying within 30 days, the Cowboys organization asks about 3 months' time to repay that amount. Pepsi will say okay, but they will say you need to sign a contract and you need to pay us interest of 3% on the balance when you're paying that note. So that's the difference between note receivable and accounts receivable. Accounts receivable does not have any interest attached to it. Notes receivable is more like a short term loan where the customers will pay interest for the remaining balance. Let's continue down the list of assets. The next asset that you might see is supplies. Supplies are things that are consumed by the business, but the business will buy in bulk and store. For example, things like paper, stationery, cleaning supplies. If you buy them in bulk, they are considered supplies and they become expenses as you use them up. Then we have things like equipment and furniture. We have land and buildings, vehicles, a lot of things that companies own. All these are assets of the company. Next, let's talk about liabilities. Liabilities, remember, are debts of the company. We're only going to talk about two types of liabilities, accounts payable and notes payable. Accounts payable and notes payable are very similar to accounts receivable and notes receivable. When it was accounts receivable, remember it's amounts that we're waiting to receive from customers. This is when we buy on credit, the company buys on credit, and we are waiting to pay our suppliers. So accounts payable is where we're going to pay our suppliers within 30, 50, or 30, 45, or 15 days, whatever the credit terms. Whereas with notes payable, it's more of a loan and we will be paying back with interest. Next, let's take a look at equity. Remember, equity is split into two parts, contributed capital and retained earnings. The contributed capital is typically, at this point, all you're going to see is what we call common stock. Common stock is a term we use for whatever the investors have contributed to the company. The money that the investors have contributed to the company or invested in the company is represented by common stock. Retained earnings has its own account. It's called retained earnings. Retained earnings represents all profits earned and kept in the business. Retained earnings has three components. The first component is revenues. Revenues, as you know, revenue is what a company earns when they sell goods or services. Revenues increase retained earnings. Next, we have expenses. Expenses are the cost of doing business. Expenses decrease retained earnings. And then we do have a third component, which is called dividends. Dividends decrease earnings or retained earnings. Dividends are defined as distribution of assets back to the shareholders. Typically, most large companies, pay back cash to their owners. So for common stockholders, they pay back cash, and we call those dividends. Some of you are probably aware of dividends, but if you go and look at some companies like Walmart, every quarter they pay their stockholders some of the money that they earn during the year, and that's a return back to the shareholder, and that is called dividends. So later on, when we are looking at the expanded accounting equation, we find that revenues increase retained earnings, expenses decrease retained earnings, and dividends also decrease retained earnings. Finally, let's take a look at the expanded accounting equation. Now we can say assets are equal to liabilities plus common stock. Remember, that is the contributed capital portion of equity, plus revenues minus expenses minus dividends. In the next section, when we go ahead and learn about transaction analysis, we're going to use this expanded accounting equation to see how transactions affect the accounting equation.